Identifying high-probability setups is one of the most misunderstood skills in trading, largely because many traders confuse activity with accuracy and complexity with edge. Personal trading literature and market memoirs repeatedly reveal an uncomfortable truth. High probability does not come from seeing more, but from filtering better. The market presents an infinite number of possible trades every day, yet only a small fraction of them deserve attention. Learning to identify those few is less about prediction and more about alignment between structure, behavior, and context. And without this alignment, even the most elegant strategy collapses under randomness. At its core, a high-probability setup is one where multiple independent factors quietly agree. No single signal carries meaning in isolation. Indicators, patterns, or news events become powerful only when they converge in a way that reduces uncertainty. The best trading books emphasize that probability increases when conditions overlap, not when signals are multiplied blindly. A clean trend, a well-defined level, clear participation, and disciplined risk placement together create a situation where outcomes are asymmetric. You are not guaranteed to win, but you are positioned so that when you are right, the reward meaningfully outweighs the cost of being wrong. One of the earliest lessons repeated across trading literature is the importance of market context. A setup that performs well in one environment can fail consistently in another. High-probability traders begin their analysis from the top down, asking first what kind of market they are in before looking for entries. Is the market trending, ranging, volatile, or compressed? This question matters because probability is contextual. A breakout has a very different likelihood of success in an expanding market than in a choppy, low-volume range. Traders who ignore context often blame execution when the real issue was misalignment with the broader environment. Another recurring theme is patience, though not the passive kind. High-probability setups are rare, precisely because they require waiting for conditions to mature. Literature written by seasoned traders often highlights long periods of observation, punctuated by brief moments of decisive action. This rhythm feels uncomfortable to those conditioned to constant engagement, but probability rewards restraint. When traders force trades out of boredom or anxiety, they dilute their edge. When they wait for price to come to them, probability quietly accumulates. Structure is another pillar that defines high probability. Markets move in recognizable patterns of expansion and contraction, and setups that align with these structural rhythms tend to outperform. Higher probability trades often emerge near areas where many participants are forced to make decisions, such as well-tested support and resistance zones, or points of failed continuation. These areas matter not because of lines on a chart, but because they reflect collective behavior. Trading literature consistently reminds readers that price is a record of human decisions, and high-probability setups appear where those decisions are likely to cluster again. Risk placement is also inseparable from probability, though it is often treated as a separate topic. A setup is not truly high probability if risk cannot be defined cleanly. Clear invalidation is a hallmark of quality trades. When you know exactly where you are wrong, you can size appropriately and remain emotionally neutral. Many trading books emphasize that setups with obvious failure points attract disciplined participants, and this shared discipline itself improves probability. Ambiguous trades, by contrast, invite hesitation, poor sizing, and emotional interference. Another subtle lesson from trading psychology literature is that high-probability setups feel emotionally quiet. They do not demand urgency. They do not shout. They often appear obvious in hindsight precisely because they unfolded without drama. Traders who chase excitement often overlook these setups, mistaking calm for weakness. Yet consistency is built on trades that align smoothly with a plan, not on moments of adrenaline. when a setup fits your rules cleanly and requires little justification. It is often a sign that probability is on your side. Experience adds another layer to this process. Over time, traders develop an internal library of patterns that have worked and failed under different conditions. High probability identification becomes faster, not because of intuition alone, but because of repeated exposure and honest review. Trading literature that focuses on mastery emphasizes journaling and post-trade analysis as tools for sharpening this recognition. Each reviewed trade refines the trader's sense of what is worth waiting for and what should be ignored. Ultimately, identifying high-probability setups is about subtraction. It is about saying no far more often than yes. The market rewards those who can resist noise, avoid marginal situations, and commit fully only when conditions align. This discipline is not glamorous, but it is effective. Over time, traders who practice this approach notice that their win rate stabilizes, their drawdowns shrink, and their confidence grows, not because they have eliminated losses, but because they have learned to participate only when the odds quietly lean in their favor. And that realization marks the beginning of a deeper shift, where trading stops feeling like a hunt for opportunity and starts feeling like a process of recognition, a process that continues to sharpen as long as the trader remains willing to wait, to observe, and to trust that the best setups rarely arrive on demand, but reveal themselves only when all the necessary pieces have fallen into place. And the market, for a brief moment, offers a situation where risk is clear, structure is aligned, behavior is readable, and the decision to act feels less like a gamble and more like a natural response to what is already unfolding, which is why the most important skill is not finding more setups, but learning to recognize the few that truly matter and having the discipline to engage only when they appear. Because it is precisely at that moment, when patience and preparation meet opportunity, that probability quietly does its work, and the trader steps into a trade not out of hope, but out of alignment with a process that has been tested, refined, and trusted long enough to carry them forward, even when the outcome of any single trade remains uncertain and the sentence does not yet feel complete, because the deeper mastery of high-probability setups begins not on the chart, but in how the trader relates to uncertainty itself. Literature written by consistently profitable traders often returns to this paradox. The more comfortable you become with not knowing, the better you become at recognizing when the odds are favorable. High probability does not remove uncertainty. It simply makes uncertainty affordable. When this distinction is internalized, the trader stops demanding certainty from setups and starts asking a more useful question: whether this trade fits the narrow conditions under which their edge historically performs best. As this mindset settles, and selectivity increases almost automatically. The trader no longer scans the market hoping to find something to trade, but observes patiently, waiting for the market to present something familiar. High-probability setups often feel repetitive, even boring, because they resemble past situations that have already been studied, traded, and reviewed. This repetition is not stagnation. It is refinement. Each occurrence strengthens pattern recognition and reinforces trust in process. Over time, hesitation fades, not because risk disappears, but because the trader has seen this movie before and understands how it tends to unfold across different endings. Another critical layer revealed in advanced trading literature is timing. A setup may be structurally sound, yet still fail if entered too early or too late. High-probability trades often require waiting for confirmation that participation has arrived, whether through volume expansion, momentum shift, or failure of an opposing move. This waiting tests discipline more than analysis. Traders who anticipate rather than respond often experience lower probabilities, not because their idea was wrong, but because their timing ignored the market's need to reveal intent. Probability increases when the trader allows the market to speak first and then acts. At this stage, journaling evolves from record-keeping into pattern diagnosis. Traders begin grouping trades not by profit and loss, but by setup, type, and context. This reveals which conditions genuinely produce edge and which merely appear attractive. High-probability setups are not theoretical, they are empirical. They earn their status through repetition and review. Literature focused on professional development emphasizes this feedback loop as essential. Without it, traders rely on memory, which is selective and emotionally biased. With it, probability becomes measurable, and confidence becomes grounded rather than hopeful. Risk management, too, deepens here. High-probability setups invite larger size, not because they guarantee success, but because their failure is well-defined and historically limited. The trader learns to press only when clarity is highest and to step back when conditions are mixed. This dynamic sizing is not aggression, it is calibration. By aligning exposure with quality, the trader protects capital during uncertainty and deploys it when the edge is strongest. Over time, this alignment smooths equity curves and reduces the psychological stress that often undermines consistency. One of the final insights emphasized in seasoned trading accounts is that high-probability setups are personal. Two traders can look at the same chart and see different opportunities, both valid within their own frameworks. Probability is not universal. It is relative to rules, temperament, and experience. The mistake many developing traders make is borrowing setups without understanding the conditions that made them work for someone else. High probability emerges when a setup fits not only the market, but the trader executing it. When style and strategy align, execution becomes cleaner and emotional interference diminishes. Eventually, identifying high-probability setups becomes less about scanning and more about recognition. The trader notices subtle cues that signal when conditions are not right and steps aside without frustration. Sitting out becomes a position. This restraint, often overlooked, is a hallmark of maturity. Trading literature consistently frames inactivity during low-quality conditions as a form of discipline equal to execution during high-quality ones. And so the lesson resolves quietly. High-probability setups are not found through constant searching or elaborate complexity, but through patient observation, contextual awareness, and relentless refinement of a narrow edge. They reward those who are willing to wait to say no and to engage fully only when alignment is clear. When this approach is embraced, trading transforms from a series of guesses into a structured practice of recognition, where each trade is simply the next repetition of a well-understood pattern, executed calmly, managed deliberately, and reviewed honestly, allowing probability to assert itself over time rather than in any single moment. If this exploration of high-probability setups reshaped how you think about opportunity and patience, consider subscribing for more deep dives into the psychology and structure behind consistent trading performance, and leave a comment sharing one condition you now realize must be present before you take your next trade.